and I'm going to talk to you about, I think I went over objective trade entry reasons yesterday, okay? But to enter a trade, you should have these, what is called objective trade entry reasons. These are going to make you more patient and disciplined trader. You should have a system of rules that you're looking for to enter a trade. So my biggest ones are: it hits my trend line, it hits my support and resistance. Then once it hits there, I have a confirmation candle. And then also I like to use my divergence, showing that the momentum will reverse. This touch the trend line twice. So that would be a preemptive trend line. Okay, you can always do preemptive trend lines if you see what price action or price structure is doing. So all right. So only tap twice, right? But I can see that it's making those higher highs and higher lows. Okay, so although it didn't necessarily hit my trend line, I still see that the structure is there for a trend line. So he's making higher highs and higher lows. So that's why I would take it as a trend. Okay, and look what it's doing. It broke that. Okay, and now it's coming down. Let me see if I answered one question. How can we know the overall market structure? I don't use the MACD, so I don't teach it. How can we know the overall market structure? By practicing looking at it. So those higher highs, higher lows on trending, that's what you're going to look for. Consolidation, that's just a ranging market where it goes back and forth between two areas like this right here. It's not really showing any movement up or down. Okay, so just looking at the market and seeing what it's doing and being able to identify those, that's going to be your first, key into charting or looking at the market, is identifying market phases. So consolidation, it broke out a consolidation, started a little uptrend. Okay, then it broke structure by making a lower low, not a higher low. Okay, broke that just to go back up. All right. All right, so this is what you want. Like I said, objective trade entry reasons. Have rules of why you're going to be entering a trade. There we go. All right, so a lot of you keep asking what preemptive and confirmation trading is. So a preemptive trader, I like to call them more aggressive traders. But preemptive traders are where it goes to that price or your support and resistance level, and you enter the trade as soon as it hits that number. Okay, you enter the trade as soon as it hits that number. You don't wait for like a rejection or a reversal or confirmation candle. Okay, confirmation trading is where price hits your support or resistance, but you're not going to enter as soon as it gets there. Okay, you're going to wait for it to, wick off or show that it doesn't like that area. And then, or even like momentum starts slowing down where it starts hovering at that area. And then confirmation candles are, it hits your area. I hope I have a picture on here. Yes, I do. So I'll show you that. And it's just showing you that you have another reversal. So instead of, just going in as soon as it hits that area, you want to wait. And this is why I like it, because it's giving you that confirmation that it's actually going to reverse. Because at any time, your support resistance can be blown through. They're not like, some kind of guard that will never go through it. So that's why I like waiting for those confirmations that, price will reverse in that area. Okay. So for confirmation trading, it's important to learn your candles. It's important to learn your candles in trading no matter what, but especially if you want to do confirmation trading, you have to know your candles. Yvette does an amazing job at teaching candles. So plug into her classes, and then the Japanese candlestick Bible is really good. So just plug into those. But what I'm talking about are confirmation candle. Okay, I look for these on my 1 minute time frame. Okay, so say price went up here. Okay, it hit my previous or my resistance, and it hit my trend line. See how it hit it and went above it. I would not have went in as soon as this hit that area. I would be waiting for areas of rejection. Okay, so I would have went in on this candle. So this is what's called a engulfing or bearish engulfing candle. Okay, so it engulfed completely this candle, and it has big push downwards. So I would have entered my trade at the last 10 to 20 seconds of this candle. 10 to 20 seconds, no matter where that price would be. So even if it was way down here, I would have entered it the last 10 to 20 seconds of that candle for 2 to 3 minutes. Okay, so say I entered down here for a 2 minute trade, right? Still 1, 2. Okay, price closed here. So I would have won, or 3 minutes. Okay, price closed here, still below that, so I would have won that. Okay, so that's what confirmation trading is. I'm waiting for a confirmation candle showing that price will go down into the desired direction that I'm wanting. Okay, this doesn't work with consolidation, because consolidation trading, it's going to move a lot quicker. And then right here as well, this is a tweezer top. See, it came almost to my trend line, but it hit my area of resistance. I wouldn't have went in there. I would have waited for this, came up a little bit more, would have went in the last 20 seconds of this candle. Okay, no matter where price is, for 2 to 3 minutes, 1, 2, 3. Okay, that was a huge drop, so I definitely would have cleared. It is possible. It is, but it's a lot less unlikely. And you're not just doing these, you know, like in the middle of, try to find an area. You're not just doing these in the middle of like a trade. You're still wanting to hit your support or resistance in your trend lines. You're not just taking these, you know, at any opportune that you see a bearish engulfing or, you know, a candle pattern. You're still wanting it to be at these key zones. Okay, does everyone understand how confirmation candles work? Does that make sense now? Do you see that? Please put a 1 in the chat if that makes sense. Put a 2 in the chat if that does not make sense. All right, awesome. All right, I'm gonna go over the broker really quick because I know there is a lot of new traders in here. So, so French is like predicting what happens next. Yes, so it's just like, okay, it hit my price, let's go in. Okay, Brooke, you don't understand. All right. So what don't you understand? Like what a confirmation candle is, or when you would enter, what aren't you understanding? That first candle isn't a confirmation candle. So this isn't a confirmation candle right here because it could still move up. It's still showing me that buyers are in control, okay? It's still showing me that the momentum, because this is still a buyer's market. Why? Because it's a green candle, okay? It is a bullish candle still. So a lot of times if you know you get spiked out or whatever, it can be because those buyers are still in the market. So I want that confirmation that price is going to reverse. Okay, I want it's showing that, you know, the sellers came in and are taking control of the market now. So like right here, I definitely would have went in with these because these are huge bullish candles showing that the buyers definitely have control of the market. Okay, anytime there's really big candles, that's showing very good momentum for up or down. So I really would have loved this one because it's showing, hey, that's a huge selling candle. That's showing me that sellers are in control. I would definitely take this trade. Okay. Yes, I'm waiting for it to reverse. I want it to show me that, hey, it's going to go in the opposite direction. Buyers are no longer in control. You said we enter at the last 20 seconds of confidently by fixed time or not? No, I never use fixed time. Okay, glad you got that. All right. So broker really quick, just want to go over this. Okay, so on your brokers, you might look a little bit different than this. This is just my race option, what I use for a demo. So over here, you'll have your currency pairs. Okay, you can scroll through there. And then over here, these different percentage, these are what the payout is for each pair. Okay, so we usually recommend only trading pairs that are 70% or above. Okay, the higher the payout, the better, but sometimes those pairs are more volatile and that's why they're paying out more. But just think of it like this, you know, why am I going to take a job that's only going to pay me $10 to do the same work? So that's why we recommend doing those higher payouts because you're going to get paid more for doing the same work. Okay. Up here, whenever you're about to trade or whatever, this is going to tell you what current currency pair you are on. So as if we're trying doing a trade call out, make sure right here this says what we're on. Over here you'll have your account balance, option type for turbo, never mess with that. Trade timing, this is where when we call out a trade, you know, say I say 390 for a put for 2 minutes, you're going to change it here. I usually don't do anything else besides 1, 2, or 3 minutes. And timing is going to depend on market volatility and how fast it's moving. Okay, so a market with like more low volume or slower moving, I'm going to do a longer time frame. So I will do like a 3-minute trade. Okay, if it's very like spiky, moving very quick, I will do 1 to 2 minutes. All right, right here. So this is going to be your trade amount. That's where you're going to enter how much you want to go in for a trade. Definitely recommend never doing a trade more than 1% of your account. So right here, if I were to do that, it'd be a $3 trade. Okay, no more than $3. Here would be your profit of what you're making on each trade. And then the green button, okay? Green button is a call or a buy. So usually when we're saying a buy, we're waiting for price to come down to an area, and then we would buy, wanting it to go up, okay? Wanting it to go back up. And you will be only winning that trade for a buy if price stays above where your trade entry is. Okay, when we call out trades, what you're looking for, so we only say the last 3 numbers of the pips. Okay, so say I call out, you know, 1.0509 right here. You're looking for those last 3 numbers.
It's important to remember that no candlestick pattern should act as a sole indicator for opening a deal.
Okay. All right, so that is what we're saying. The last 3 numbers up here, that's all you're wanting to look at. And then for a sell, we are wanting, you know, we're waiting for price to go up to a certain area just to go back down. Okay, and you're only winning that trade if it is below your trade entry for a put. Okay, and then we have rollovers and double ups on some brokers, like Pocket Options does not have rollover and double ups. Okay, so these are only going to work if you're losing the trade. All right, double ups are when you're entering. Double up is like, okay, it spiked up, but I still believe that the market is going to go back to where I want, but I want this better trade entry. So you would enter again or at a different entry. and it's going to, repeat your trade amount. So say I went in for a $10 trade, now it's going to give me another $10 trade, but with the same expiration time as my first one. Okay, so it's just giving you a better entry with the same expiration. Okay, a rollover is where you believe you just need a little bit more time for that trade to play out, so you'll roll it over. I don't recommend doing any more than 2 rollovers in a trade. If you have to do more than that, just let it go and get a better entry. Because when you keep rolling over, it adds to that trade or your trade amount. Meaning every time you roll over, it's taking 30% more of your trade. So say I go in for $10, I roll over once, it's going to add 30% more. So now you're in for a $13 trade, and you only get so the first rollover, I believe you get double your time, and then the second rollover, you only get 30% of your time. Does that make sense? But each time you roll over, it's adding another 30. So you went in for a $10 trade, you roll over twice, now you're in for a $16 trade, and that can push you over your risk, meaning you're over leveraging now if you roll over too much. So that's why I don't recommend just rolling over and rolling over, because now you're over leveraging. You can tell a market's volatile by like very erratic movements, very long wicks, very long wicks, very long body candles, and it kind of all over the place, not really respecting any support resistance. All right, last little part of this one, and then I'm going to go into EMAs and divergence. So always just be patient with the market, guys. Let it come to you. Don't chase it, because you will get bodied, I promise. Wait for those good trade entries. Wait for it to hit your objective trade entry reasons. And then always know that losses are going to happen no matter what. It's just part of your journey. Okay, even the best traders, we still have losing days. That does not mean that you don't know what you're doing. So anytime you have a losing day or a couple losing trades, don't like rethink your whole strategy. Okay, sometimes that can screw you up more than anything, is constantly changing your strategy because it didn't work for you 1 to 2 trades. Okay, stick with a strategy for at least like 2 weeks, at least 2 weeks before changing. Okay, because when you keep changing and not giving it any time to really work on a certain strategy, you're just going to confuse yourself. Okay, anytime you do lose, make sure you figure out why you lost. If you don't know why you lost, reach out to a leader. Okay, we want to make sure that you understand why you're losing. All right, and just fall in love with the process and know that you will get there eventually. Just keep doing. What strategy do I use? My strategy would be like I use trends and then EMAs and divergence. All right. My Telegram is at Kylie Gavia. Hold on 1 second. Okay. Kylie has no strategy. Geez, thanks. All right, I'm gonna go a little bit into technical indicators. Do not recommend using any kind of indicators until you get support and resistance down at market structure. Okay, market structure, price action, those are going to be, how you're going to do better at trading and level up your game. Those are the very basics to know before adding anything else. Okay, so all technical indicators are doing is it's using confluence or additional confirmation to enter your trade. Never ever use them as a sole reason to enter your trade. Like I said, that market structure, support and resistance, those are going to be your keys. These are just that extra like confirmation to know that price will go where you want it to go. Okay, there's like hundreds, I think, of different indicators, hundreds. Okay, the ones that I use are EMAs, divergence, and the Fibonacci. Okay, those are the main ones I use, but I'm just gonna go over EMAs and divergence. I'll do fibs, maybe next week I'll go over fibs. All right, so what EMAs are exponential moving averages. Okay, it moves with the average or median price of the last however many candles on that EMA. Okay, so the 20 EMA, it's taking into account the last 20 candles, dividing that price, whatever that price is, by 20 of those last, and then giving you that average number. Okay, so it's moving with the average of the last 20 candles. Same thing with the 50, 100, 200, taking into account the last 100, 200 candles, figuring out what the medium is, and then moving it like that. I do not use currency strength meter unless I'm doing like in consolidated trading, which I don't normally do. Market structure is going to trump currency strength. Okay, so EMAs act like magnets. Okay, they don't like being far from them, and price will get pulled to them eventually. Okay, the fastest is going to be the 20 EMA, and the strongest is going to be the 200. Why? Because they count more candles. So the 20 is going to be faster because it's only taking into account the past 20 candles. 200 takes a little bit longer to catch up because it's taking into account the past 200 candles. Okay, candles are above the EMAs, we're going in an uptrend. Candles are below the EMAs, we're going in a downtrend. I'll show you what that looks like. EMAs, when EMAs are spread out, it indicates a strong trending market. Okay, so let me show you what all of these look like. Let me turn on my EMAs and let me show you what EMAs I personally use. So right here, this is what I use, EMA 20, 50, 100, 200 by Dr. Sweets, the 6461. Okay, that is the EMAs I use. My PowerPoints. Is that what you mean, Gladys? Possibly. I have to ask our leader if that's allowed, but I believe I am able to send these out. I have to ask Alex if I can send out my PowerPoints. So yes, default settings for EMAs, I don't change them. If you guys don't like the colors on them, if you can't see them that well, you can definitely put two of those on there now. You can change them, but don't mess with the settings otherwise, or else it's not going to like truly work. I don't change the settings, so you don't really need to see the settings. No, DeLorean's different. I mean, it's the same idea because it's still an EMA, but it's used differently. The DeLorean is used differently. Okay, so EMAs, uptrend, downtrend. I'll do 5 minutes so we can see a little bit better. All right, so see how it is in an uptrend or a big movement upwards. All right, it is above the EMAs. That's showing we're in an uptrend. See that? It's above the EMAs. Once they start crossing over, going over them, that's an area consolidation. Okay, I don't really use my EMAs in consolidation. You can't really use them besides knowing when it's going to break out of that consolidation. All right, so uptrend above the EMAs, downtrend below the EMAs. Candles are below the EMAs. All right, and again, when you can start seeing them cross over the EMAs, that's going to be an indication to me that that trend is going to reverse or break out. So when I see them start getting closer together like this or start crossing one another, I know that the trend may end. Okay, that's what I mean by that. 1 second. No. All right. So Another thing to look at that I use for EMAs is called the golden cross and then death cross. This isn't the name I came up with, this is the name. Okay, so what that means. So anytime those smaller, the 20 EMA and the 200 EMA cross, that's called the death cross, okay? And what that is indicating is that a trend is about to form on the downward, okay? So death cross means it's going down. Sorry, this was for my Spanish class. But that is a death cross, okay? They're crossing downwards and there's usually a huge movement down. So it crossed and then made a big movement down, okay? And that is indicating that it's going into a downtrend. Opposite is called a golden cross. This is where the slower EMA, the 200 and the faster 20 cross, and that is going to indicate an uptrend. Yes, 20 EMA is the red one. Gold is the 50, the aqua is the 100, and then the 200 is that blue one. Okay. Do you guys see that? Does that make sense to you? So anytime I start a trend or looking for a trend, I'm looking for these crosses and then a wide set spread of those EMAs. Anytime they're spread out nicely like that, that indicates a strong trend. Okay, so when the 20, this faster moving average, the red one, and this blue one, the 200, whenever they cross like that, see how they crossed? That is an indication that it will start a trending market. Okay, that's indication it's going to start a trending market. So if it crosses downwards, that's showing me that it is going to start going in a downtrend. Okay. Opposite for them crossing upwards. So this 20 EMA goes above the 200 and it crosses upwards. That is indicating to me that the market is now going to go in an uptrend. Exactly. Golden up, death down. Okay, so if it crosses down, downtrend, crosses upwards, uptrend. That makes sense? Again, like, do you guys get that? You see that? Come again, please. Okay. I don't know how to break this down anymore, but so the fastest moving average, the 20 EMA, this red one right here. Okay, it's crossing the 200. Okay, so it goes down and it crosses it right here. It's crossing it. That indicates a downtrend. You can use whatever EMAs you want. Honestly, this is what I like to use. Like Alex, he just uses the 200. I like the 20 EMA the most, and I'll show you why. Okay, and so does that make sense, guys? Okay, and then they cross upwards, so that 20 EMA is coming up and it crosses that 200. That's indicating an uptrend. You see it? Does that make sense? Sorry, I just don't know really how else to explain it. But just keep it simple. So 20 EMA, that red EMA crossing the blue one, okay? The fastest EMA and the slowest EMA crossing each other indicates that price is going to go down in a downward direction. Got it. Perfect. All right. Oh, right here. Okay. So why I like the 20 EMA, you can kind of use it as a trend line. If you guys are on our London section, you usually see me and Jessa going off that 20 EMA because we use it as a trend line. Okay. A lot of times price will cross over that and then go back down or go back up. Okay. So let me show you what I mean. All right. So here I drew a trend line, right? I drew my trend line. That green line is my trend line. But as you can see, price didn't really ever reach that before going back down. Certain times we're in a strong trending market, you can use that 20 EMA as a better entry for or I guess a more aggressive entry for a trend line. Okay, see how it overshot, then it sank. Came up, overshot, then it sank. Okay, so that's also how I like the 20 EMA, and that's how I use it. I wait for those nice overshoots, then I go in for a sell. Okay, because it didn't quite reach here, so it just gives me more trade entries. Okay, do you guys see that? It didn't quite hit my trend line, but it hit that 20 EMA sank. Hit that 20 EMA sank. Hit that 20 EMA sank. Understood. Perfect. Okay, and the 200, I'm not going to actually go over that. That's Alex's. He can go over Slingshot with you guys. Okay, so that is how I use that 20 EMA. And then, so the 200, like I said before, is the strongest EMA, and price pulls to it a lot. So right here, you see how it's a strong trending market. Okay, was a nice trend, but it came up to that 200, and then it sank again. Came up to that 200, sank again. So if price is close to that 200 EMA, I try to be mindful of that and knowing that price can get pulled there. So I want to be wary of it pulling there. Hey guys, look what did from earlier when I marked it, came down, hit my support resistance, and then went back up. But anyways, so say price was like right here, I would have been a little wary of taking that trade. I definitely would have wanted that confirmation candle because that 200 is right there. So it could have easily broken through that and went there because it's like a magnet, it pulls to that. Okay, so a lot of times we'll be looking at our higher or lower time frames to see where that is to make sure that it's not close to that and price won't pull there. Okay, if it's not close to there, but price is pulling a little bit further down, I'm okay in either doing a roll up, rollover, or I can look for that double up at that 200. Okay, so that's why it's important with that multi-time frame analysis. Okay, I'm going back and forth looking at those EMAs and where it is. Does that make sense? Slingshot is a strategy that Alex uses. So I'm gonna let him, teach you guys that. Don't understand. Okay. So like I said, the EMAs are like a magnet. They like being close to price. Okay. So if price is going like the opposite direction that I wanted it to go, I would be going on the higher time frame. So I usually look for my trade entries at the 1 minute, correct? Okay, usually look for them at the 1 minute. But if it's going like past, so say, let me find it here. All right, so say price came down here, okay, or like right here. I would be wary of it pulling past and going here to catch that 200. Okay, so I always want to look at the 5 minute and see where it is. Okay, so sorry, I'm having a hard time trying to explain this correctly. On the 5 minute, it likes that 20 EMA. On the 1 minute, it'll a lot of times pull down to this 200. So I go back and forth and see where it is. Okay, price is all the way up here. Say it shoots past it or it's not coming down to it. Okay, I would want to look at the 5 minute to see where that 20 EMA to see if it's coming down there or what it's doing. Does that make sense? I didn't explain that very well, I know. But I'm trying to look at those multi-time frame for where the EMA is. So like on the 5 minute, if it's away from this 20 EMA, I know it's going to pull down there. Okay, which on the 1 minute may look like the 200 because they're on different time frames. They're going to look different because the candles are going to be different on those different time frames. Make sense? Does that make sense, guys? Put a 1 in the chat if it makes sense, 2 if it doesn't. I have like 5 more minutes, so I'm not going to be able to go over divergence again, but we will get that next week. We'll just do a whole class on divergence and maybe alpha run fits. Okay, awesome. So we're about to go over to London session, do some trades. Okay, guys, I hope this was helpful. I hope you learned something. If you didn't, just hit me up on Telegram. I put my name in there, and then I will try to explain it better to you guys. Awesome. You're welcome. You're welcome. All right, we'll see you over at London session. Thank you guys for joining. I appreciate you all.